Hello, everyone. My name is Janet Jackson, and I'm the owner and founder of Insure with Janet Jackson Life Insurance Brokerage Agency. You're here with me today on Life with Janet Jackson, where we discuss everything that is life insurance, whether it be protection, savings, banking, financing, budget, because life insurance encompasses all these things. We're going to discuss something that I've had a number of questions concerning recently, and we're going to be discussing distinguishing between term life coverage and whole life coverage. But before we move on, I want to share with you the definition of insurance. Insurance is the transferring of risk and loss of an individual or business entity to an insurance company, whereby the insurance company spreads the cost of that loss to many people. And that's why it's economical for us to purchase life insurance to cover us and cover our loss. So we're going to move on and we're going to discuss term coverage. Term coverage is also referred to as pure life insurance. And when you think of term, I want you to think of temporary, because you're getting protection for a temporary period of time, a term. And you have two types of term coverage. You have a 1-year renewable term, and you have level premium term. Now, the 1-year renewable term is definitely the least expensive to start out with, because you're paying for each year and you're starting out younger. So you're going to pay that premium for 12 months. And after that 12 months, if you want to renew it, that next 12 months is going to be more expensive. And after that 12 months, if you want to renew it, that next 12 months is going to be even more expensive. And it continues to go up because it's yearly renewable term. And if you decide that you're not going to renew the coverage and you won't get any more, if you did not pass away during that contract period of each year, then you or your beneficiary will not receive the face amount or the coverage amount. So if you did not pass away during that term, once again, your beneficiary will receive no funds. You have just paid for protection during that period of time. The next one is level premium term, which most of us are probably more familiar with. And this is the larger bulk of time or the larger bulk of term. That refers to 10 years, 20 years, and 30 years. And basically what the insurance company does is they will take the average of your premiums for each year during that, for example, 10-year period. They will average it out and provide you with a discount, and you will pay that same premium for 10 years. Once that 10 years is up, if you did not pass away, you get nothing. You have just paid for 10 years of protection just in case you did pass away. Now, you have also a decreasing term coverage, and this is unique in that this is often used for mortgage protection. Now, with this coverage, the premium or the cost that you pay each month will remain the same for that period of time, and usually it's 30 years, because that's when most of us have a 30-year mortgage. So you pay that premium, which will remain the same throughout the 30 years, but the benefit, the death benefit that will be paid to your beneficiary will decrease each year, because as you know, the longer you're in that mortgage, the less you will have to pay off. So, for example, if you pass away 10 years within that mortgage, then you will have a lot more to pay than if you passed away at 25 years during that coverage. So, in the same way, that decreasing term, the amount that your beneficiary will get will be less as time goes on. So, the great thing about term coverage is oftentimes with the 10, 20, and 30 years of coverage, we actually have convertibility. Now, the good thing about convertibility, you can choose to take a portion of that term coverage and convert it over to a whole life policy. The great thing is that whenever you purchase that coverage, if it was 10 or 20 years ago, you have the ability to purchase a bulk of that coverage at the same rate that it would have been at the start of your coverage. For example, if you were 20 years old when you bought that 20-year term policy, and at 10 years in, you decide to purchase $10,000 of whole life coverage and convert it over to whole life coverage, you will only be paying what you would have when you were 20, when you started that 20-year coverage, and not the age that you are when you decide to convert it. So that's a great benefit, because they're determining the rate for the age that you were when you bought that term. So that's the positive part of term coverage. The downside is you're investing in this coverage for a period of time, 10, 20, 30 years. And God forbid, if you do not pass away during that term period, then nothing. You have just paid for that period of time. Now, the next one that we're going to be talking about is whole life coverage. There's basically two types of whole life coverage. You have the general whole life coverage, and you have universal whole life coverage. With universal whole life coverage, it's less expensive because basically you are actually taking on the risk of the coverage more so than the insurance company. Because with the universal coverage, you have death benefit, and you actually have the cash value that will increase over years. But the death benefit is determined, or the premium is determined by the same thing as a 1-year renewable term. So the cost of that basic face value is going to continue to go up, even though the cash value that's in your policy will continue to go up. But at some point, the premium for your life insurance is going to be more expensive than the cash value that is growing in the savings portion of it. And it's flexible because you can also choose to either pay the total amount of the premium, which is preset, or you could say, I don't want to pay that much this year, and you can pay less. But in doing that, you're also running the risk of not having enough money put in to secure the death benefit. So that's the risky portion of universal life. Now, the general whole life policy is great because, once again, you have the death benefit and you have the cash value that also builds over the years. So you can take that cash value that's built and you can use it, you can borrow that out of your coverage and use it to make a purchase, say a home, purchase a car, pay some bills off, and the interest rate for paying that back is going to be small compared to other places that you would have to get that loan, and you're taking it from your money. Also, the interest or the cash value continues to build at the rate as if that same money that you borrow is still within that policy. So it continues to grow so that when you put that money back, you don't lose anything. Of course, with the whole life policy, this is going to last you for the rest of your life. And it usually matures at either 100 or 121, which is at the point where you would have paid in the amount that the coverage provides that will equal what the face amount is. So this is an excellent vehicle for you to use to contribute to your financial portfolio, because depending on how large your policy is, you're not only providing protection for your family, you're providing bank for your family, and there is a certain security involved with this, so that a whole life policy should be considered as part of your financial portfolio. Now, my question to you is, which policy would you prefer and why? Thank you for being here today. And if you like the information that I'm sharing with you, please push the like button and subscribe. Thank you so much. I'm Janet Jackson.